Regular viewers of our webcasts will know that Michael Hughes is our independent economic consultant and he's also a key member of our investment team. Good morning, Michael. Thank you for coming in today. We're hoping that you'll give us your latest views on the global economy and also what's happening within the UK.
Well, I think if you look at how 2014 is panning out, there's been a sense of relief that economic recovery has gathered some degree of momentum, not in Europe admittedly, but elsewhere. We haven't had the great downturn that was feared in China, and the reform packages that we've seen in Japan, in India, now in Indonesia, do seem to be coming through to change the approach to the Asian governments. So by and large, you could say, that doesn't sound too bad. But from an investor's point of view, this has been a pretty mixed year. Even the investors who can take the higher levels of risk have only seen returns of 2–2.5% in the first half of the year. And that compares with 10, 15, 16% returns that they saw in the previous 2 years. So if anything, the markets have started to slow down somewhat, and part of that is a reflection of valuation, and part of it is actually a sense that let's look into 2015 and beyond, because markets are forward-looking, and by and large we're not so certain that this economic momentum can be sustained.
So that implies there are some more notable developments on the horizon into 2015 and possibly beyond.
Yes, I think there are. Firstly, if you look at a lot of companies worldwide, they have built up a huge amount of cash. Mm-hmm. And this is the stage of the cycle where if they have confidence, they start to invest that in plant and equipment and expansion. And hence that gives the momentum to economic growth over the next 2 or 3 years. They appear to be very cautious in doing that. In fact, an awful lot of them are either preferring to give the cash back to shareholders or buy in their own shares so that their own earnings per share goes up, but very cautious in the degree to which they're committing to their own expansion. And that may suggest they have some concerns about the momentum of economic growth looking out 2 or 3 years. So that is different. And the other thing which is more positive, though, is the degree of reform that we're beginning to see in the Asian economies. For some years now, India has been regarded as a very major economy, but going nowhere because it was stuck in a bureaucratic constraint. Well, the new government that's come in there is taking some of those bureaucratic restraints away, some of the red tape, some of the difficulties in encouraging investment, and that's a very positive sign. It will take a time to come through. These things don't happen overnight. If you look at Japan, the reform program there is also being reeled out again, relatively slowly, but nevertheless it is an important feature. And Indonesia, which has also had elections, looks as if they too are now going on a reform program. So if you put all that together, and you look at the reforms that are coming out of China that were introduced last year, you can see that the Asian story is starting to look much more interesting and more reassuring. So whereas we in the West might be feeling, well, why aren't companies leading the charge? We can look out to some of the Eastern economies and say, no, actually, if they're going to lead the charge anywhere, maybe that's where we are going to see that recovery come and gather momentum.
I mean, last time we discussed what's happening in the global economy. One of the main concerns was about growth momentum, and at the time then still the very early days, if even then, of the tapering of quantitative easing. Obviously that process is not yet complete, in some places not even started. So to what extent, because there's a lot of good news, positive news in some of the things you said. So people might think, well, in that case, why is there this uncertainty? Why are companies holding back? Is it partly because we're still in unknown territory as far as what the central banks have been doing and are still continuing to do?
Yes, I think there is partly a concern that once quantitative easing does stop and you start seeing interest rates go up, you may find that the global economy really slows down because we have built up an awful lot of debts, and hence the debt servicing costs will eat into spending power and make it more difficult and more expensive for people to consume and to invest. So there may be a sense that it is an unknown, but we know that at some stage we are going to have to see that being reined in. The other thing is that if you look at the way profits have come through, there's no doubt that profits have been building up now for some years, which is a positive sign, but most of the build-up in profits have taken the form of higher profit margins and not big increases in the growth of total revenue. And the significance of that is that companies tend to be more confident to invest if their total revenues are building up, not just as if they're able to increase their margins. And I think that balance has also marked this out as being a very different sort of recovery to the economic recoveries we've become familiar with in the last 20 or 30 years.
Sure. I mean, how do you see that sort of all play in relation to the UK? I mean, we've had in the recent past a cabinet reshuffle. We've got the election due next year. We're coming to the end of the first fixed-term parliament I think we've ever had in our history. And given what's happening with the stock market, which has been up until fairly recently certainly has been pretty positive. So how do you see that scenario, if you like, unfolding as we move ahead through the rest of 2014 and into 2015?
Well, I think politics are going to be a much bigger feature in the UK markets, partly because of the reform programme which they're trying to introduce in Europe, and we'll see how much progress we make there, but also because of the uncertainty of the election outcome next May. What we know is that there is still a large deficit that has to be tackled. They've taken some austerity measures in this first term, but it was always likely that you needed 2 terms to actually get the debts under control. So a large part of the austerity programme has yet to kick in. Only something like a third of the spending cuts that were planned have actually been implemented so far. So more of those have yet to come. So depending on who wins that election will very much determine whether the deficit is controlled by more austerity or by higher taxes. And that uncertainty, I think, is going to weigh on the market as we go through the rest of this year.
You sort of touched on it in part, but as a sort of just a separate overview, there is a recovery going on in economic terms, but it's not on a uniform basis, as you said, from around the globe. Can one define how it's different than what's happened with economic recoveries in the past?
Well, I think there are 4 major differences in this economic recovery to previous ones. The first is that the emerging world, the so-called developing economies, are now physically bigger than the developed ones. We have now seen the balance of power shift away from the G7 or even the G20 economies to the new ones in Brazil, in Mexico, in Indonesia, obviously India and China. So that balance is changed, and hence what happens in the emerging world now has a greater consequence for us than it would have done previously. The second difference is that companies, as we've been discussing, are behaving differently. They're not behaving with the same degree of confidence that you would have assumed they would have done, given the build-up of profits and the opportunities to invest. The third difference is the way that the labour market is quite different. Yes, we've created an awful lot of jobs, but many of them seem to be part-time jobs, or indeed, there are people who are now self-employed. So you don't have the same build-up of consumer income as you would have done in previous recoveries. You don't have the same levels of unemployment, admittedly, but you haven't seen the growth in wages that have come through at this stage of the game in previous cycles quite significantly. So that's much more subdued than we've seen previously, and hence that will be a note of caution for people in their planning process. And the final thing that's different is that the supply of credit is quite different this time. Banks are clearly under greater constraints than they were previously. It is much more difficult to obtain a mortgage than it would have been in previous recoveries, and by and large people already have a lot of debt, so they're not looking to add hugely to it. So there are some significant differences than in this economic recovery from the previous ones. And a final one, which I think is worth noting, is that we have had a set of monetary policies that are quite unprecedented in our economic history. We've never seen central banks print money to this degree, and hence when they start to take that away, that may be a moment where markets have to readjust their valuation bases, and we may find that life gets a bit tougher.
So when you talk to us again in, let's say, broadly 6 months' time, what particular things would you be looking out for in terms of what has evolved over that period of time from where we are now?
Well, one of our themes for this year, which has been very different from the previous 3 years, is that we're aiming to take less risk. We're doing that in 2 ways. One, we're moving more towards what I call real assets, so infrastructure, commodities, property, things that we think the valuations are still attractive and where there's a degree of an inflation hedge as well, in case inflation tends to be a bigger problem in the future. And secondly, where we feel that stock markets are looking a little expensive, we are withdrawing from them, not aggressively, but we are planning to actually take less equity exposure during the course of the year, because we believe there will be some negative surprises in 2015, and we'd rather be ahead of the game and take some of the profits that have been made rather than lose them when something comes out of the hat and surprises everybody. So if anything, we are just playing a much more cautious game this year than we have done in previous years.
Thank you very much for that. Thank you for your wide-ranging view of what's going on as per normal, and I look forward to talking to you again on the next occasion.
Thank you, John.
Thank you.